There are two types of people on the internet when it comes to Bitcoin. Type 1, the Bitcoin believer. This person has a laser eyes profile picture. They call everything else fiat garbage. They have a price prediction that involves at least 6 zeros. And they will reply to any criticism of Bitcoin with one word, ingi, which apparently means not going to make it, as if owning a volatile digital asset is a personality trait. Type 2, the Bitcoin hater. This person calls it a Ponzi scheme every chance they get. They have been predicting the death of Bitcoin since 2013. They were wrong in 2013. They were wrong in 2017. They were wrong in 2021. But they are absolutely certain they will be right eventually. Here is the uncomfortable truth about both of these people. They are both partially right, and they are both dangerously wrong. Because Bitcoin is not a simple story. It is not purely a scam, and it is not purely the future of money. The real answer sits somewhere in a gray, uncomfortable middle that neither side wants to admit exists. So today we are going to do something that almost nobody on financial media is willing to do. We are going to steelman both sides, the strongest possible bull case, the strongest possible bear case. And then we are going to reveal the third scenario, the uncomfortable middle that nobody is positioning for and almost nobody is talking about. Let us start with the bull case, because honestly, it is stronger than the haters want to admit. The bull case. Bull argument 1. Digital gold. The most powerful bull argument for Bitcoin is the simplest one. Gold has been a store of value for over 5,000 years. Not because gold is particularly useful. You cannot eat it. You cannot build a house with it. A significant portion of gold demand is purely because humans have collectively agreed for thousands of years that it holds value. Bitcoin believers argue the same collective agreement is forming around Bitcoin, and the numbers are starting to support that argument. There are approximately 21 million Bitcoin that will ever exist, hard-coded into the protocol and mathematically impossible to change. Gold can always be mined in larger quantities if the price rises enough to justify it. Bitcoin cannot, and here is where it gets interesting. The total value of all gold in the world is approximately $13 trillion. Bitcoin's current market cap sits around $1.3 trillion. If Bitcoin achieves even partial parity with gold as a global store of value, not replacement, just partial parity, the price per coin would need to be around $600,000. That is not a crazy person's number. That is basic math applied to a store of value argument. Bull argument 2. Institutional adoption is real. 4 years ago, institutional investors treated Bitcoin like a joke. Today, that is simply not true. BlackRock, the largest asset manager on earth with over $10 trillion under management, launched a Bitcoin ETF in January 2024. It became the fastest growing ETF in Wall Street history, attracting over $10 billion in its first 2 months. Fidelity followed. State Street followed. MicroStrategy has accumulated over 200,000 Bitcoin on its corporate balance sheet, and several sovereign wealth funds have quietly begun allocating to Bitcoin as a reserve asset. This is not retail investors gambling on their phones. This is the most sophisticated money on the planet making a considered allocation. These institutions have teams of analysts, risk managers, and lawyers. They did the homework, and they decided a small allocation made sense. When BlackRock builds a product for Bitcoin, it is not because they believe in the revolution. It is because their clients want the exposure, and the risk-adjusted return profile has become defensible at small allocation sizes. Bull argument 3. The halving cycle. Every 4 years, the amount of new Bitcoin created is cut in half. This is called the halving. It has happened 4 times now, and each halving has historically been followed within 12 to 18 months by a significant new price peak. The most recent halving happened in April 2024. If the historical pattern holds even approximately, the bull case suggests we are currently inside or approaching the window of maximum price appreciation. Now, correlation is not causation, and past cycles do not guarantee future results. But the halving is a mathematically predictable supply shock. And when demand stays constant or grows and supply suddenly shrinks, basic economics says price goes up. Bull argument 4. Inflation hedge narrative. With the US national debt at $36 trillion and growing, with governments globally printing money at historic rates, and with real interest rates frequently turning negative, the argument that hard assets with fixed supply are valuable is not crazy. Bitcoin's supply is fixed. The dollar's supply is not. That simple asymmetry is the foundation of the entire inflation hedge narrative. And in a world where governments have demonstrated they will print whatever is necessary to keep the system running, that narrative has real legs. So that is the bull case. Fixed supply, growing institutional demand, historical halving cycles, inflation hedge narrative. Combine these make a genuinely serious argument. Now let us look at the other side, because the bear case is just as serious. The bear case. Bear argument 1. It has no intrinsic value. Gold has industrial uses. Stocks represent ownership in real businesses with real cash flows. Real estate produces rent. Bonds pay interest. Oil powers the global economy. Bitcoin produces nothing. It pays nothing. It is backed by nothing except the collective belief that someone will pay more for it in the future. That is the definition of a greater fool theory. The only way to profit is to find a greater fool willing to pay more than you did. And collective belief is a terrifyingly fragile foundation. History is littered with assets that had enormous collective belief right up until the moment they did not. Tulip bulbs in 1637, Beanie Babies in 1999, Terra Luna in 2022. The mechanism that drives prices up through collective belief is the exact same mechanism that drives them to zero when belief evaporates. Bear argument 2. The volatility problem never goes away. Bitcoin's annual volatility consistently sits around 60%. For any asset to function as a reliable store of value or medium of exchange, it needs price stability. Gold's annual volatility averages around 15%. The US dollar is designed to maintain stable purchasing power. Bitcoin has dropped 80% multiple times. An asset that drops 80% cannot simultaneously be a reliable store of value for ordinary people. A retiree cannot allocate meaningful savings to something that might lose 80% of its value in a single bear market cycle. The volatility problem does not disappear as Bitcoin matures. It has been 16 years. The volatility is still there. And as long as the volatility is there, the store of value narrative has a fundamental credibility problem. Bear argument 3. Regulatory risk is existential. Bitcoin's entire value proposition depends on governments allowing it to exist and function. And governments have demonstrated repeatedly that they are willing to restrict or ban crypto when they feel threatened. China banned crypto entirely in 2021. India has imposed severe restrictions. Multiple governments are developing central bank digital currencies, government-controlled digital money, that would directly compete with and potentially crowd out Bitcoin. And here is the darkest regulatory scenario. If Bitcoin ever genuinely threatened the dollar's status as the global reserve currency, the United States government would not sit back and watch. The US has the most sophisticated financial enforcement apparatus in human history. If they decided Bitcoin was a threat to dollar dominance, they have the tools to make it extremely difficult to use, hold, or trade. Bear argument 4. The energy problem. Bitcoin's proof-of-work mining consumes more electricity annually than some entire countries. In a world increasingly focused on climate and energy efficiency, that is a significant and growing liability. ESG mandates are forcing institutional investors to consider environmental impact. Regulatory pressure on energy consumption is increasing globally. And the environmental argument gives politicians a popular justification to restrict Bitcoin mining that has nothing to do with financial regulation. The energy consumption is not a minor side issue. It is a fundamental feature of how Bitcoin works. You cannot fix it without breaking the protocol. Bear argument 5. The concentration problem. Despite the decentralization narrative, Bitcoin ownership is extraordinarily concentrated. The top 1% of Bitcoin wallets control approximately 90% of all Bitcoin. Early miners, early buyers, and large institutional holders have accumulated enormous positions at near zero cost. When those early holders decide to sell, and eventually they will, the selling pressure will be absorbed by the people who bought at much higher prices. The decentralized revolution looks a lot like a very centralized wealth distribution when you examine the actual wallet data. So that is the bear case. No intrinsic value. Persistent volatility. Existential regulatory risk, energy consumption, extreme wealth concentration. Both cases are serious. Both have real data behind them. So where does that leave us? Sponsor break part 3, the uncomfortable middle. Here is the scenario that almost nobody is talking about. Not a moon, not a zero. Something far more psychologically difficult than either of those outcomes. What if Bitcoin just stays? Not at $1 million, not at zero, but somewhere in a permanent state of uncomfortable ambiguity, too legitimate to die, too volatile and too concentrated to actually function as the financial revolution it promised to be. Think about what that actually looks like. Bitcoin survives. The price fluctuates between enormous bull runs and devastating bear markets. Each cycle, fewer ordinary people get rich because the early money is already too concentrated. Institutional investors use it as a small portfolio allocation, maybe 1 to 3%, and treat it like digital gold. Governments regulate it heavily enough that it cannot threaten their currencies, but not so heavily that they kill it entirely because the institutional lobby is too powerful to ignore. The result? Bitcoin becomes a permanent speculative asset class, not a currency, not a store of value in any reliable sense, not a financial revolution. just a volatile digital commodity that sophisticated investors use for occasional portfolio diversification and ordinary people lose money in at the peak of every hype cycle. And here is the cruelest part of this middle scenario. The people who benefit most in this world are not the believers and not the haters. They are the traders, the institutions, the exchanges, the people who profit from volatility itself regardless of which direction the price moves. The same people who have always profited from financial markets, the intermediaries, end up profiting from the technology that was specifically designed to eliminate them. The revolution becomes just another asset class. And the ordinary people who bought Bitcoin because they were angry at banks and believed in financial freedom, they are still at the mercy of the same forces they were trying to escape. Except now those forces are wearing a hoodie instead of a suit. That is the uncomfortable middle. And right now that middle scenario is more likely than either the laser eyes crowd or the zero crowd wants to admit. So where does this leave you? If you are already holding Bitcoin, understand what you actually own. You own a volatile speculative asset with a genuinely interesting supply dynamic and genuinely serious structural problems. Treat it like one small allocation, money you can afford to lose, no leverage, no emotion. If you are thinking about buying Bitcoin, understand that the easy money was made a long time ago. The risk-adjusted return profile today is very different from 2013 or even 2017. The upside is real, but so is the downside. And in the uncomfortable middle scenario, the price could go sideways for a decade, while inflation quietly eats your purchasing power. And if you have been predicting Bitcoin's death since 2013, it is probably time to update your model. Because something that survives multiple 80% crashes, regulatory bans in major economies, the collapse of its largest exchange, and the death of its most prominent stablecoin, while still maintaining a $1 trillion market cap, is not going to zero quietly. The honest answer to Bitcoin going to $1 million or zero is this: nobody knows, and anyone who tells you they do is either selling you something or selling themselves something. What we do know is this: the financial system has real problems. The anger that created Bitcoin is legitimate. The technology is genuinely interesting. But interesting technology and legitimate anger have never been sufficient on their own to create lasting financial value. Value requires utility. Utility requires stability. And stability is the one thing Bitcoin has never been able to consistently deliver. That is the story traditional financial media will not tell you, because it is not exciting enough for a headline. The bull case does not get clicks. The bear case does not get clicks. But a confident prediction in either direction, that gets clicks, that gets shares, that gets followers. We are not here for clicks. We are here for the truth. Even when the truth is uncomfortable, even when the truth is we do not know. Hit subscribe if you want more of that. Because in a world full of confident predictions, honest uncertainty might be the most valuable thing on the internet.